Hello and welcome to the March 15th, 2024 episode of Watching the Tape. If you have big-time charitable intentions and you wouldn't mind reducing your tax burden, then here are two of the more commonly used philanthropic tools: donor-advised funds and charitable remainder trusts. A donor-advised fund is an investment account that holds donated assets until they are granted to selected charities, while a charitable remainder trust is a trust that generates annual income for the donor, with the remainder of the donated assets going to a selected charity upon the donor's death or after a set number of years. Now, I love a good side-by-side comparison. By comparing and contrasting these two options, it should help with a deeper understanding of them and what might make sense for you if this is something you're considering down the road. So let's jump into it. Is one of them easier to set up than the other? Absolutely, no question. Donor-advised funds are easy to set up. Charitable remainder trusts, on the other hand, require legal assistance. They cost a lot more to set up. For that reason, they are used for larger sums of money. There's no required minimum for charitable remainder trusts, but I don't think it would make sense for anything less than $1 million. Both are good for highly appreciated assets. Donate the assets, get the tax deduction for the value of those assets, and there's no need to pay any capital gains taxes. Are the transfers irrevocable? Yes, in both cases. There's no getting your money back here. And related to that, these assets are no longer in your estate, so they are not subject to estate taxes at your death. Is there flexibility to choose charities and the timing of those donations? With donor-advised funds, you can contribute a lot to them this year, for example, take the tax deduction, and then have the money distributed to various charities of your choosing over several future years. In the case of a charitable remainder trust, the charity or charities and the distribution timing are set during the establishment of the trust. Which one provides income during the donor's lifetime? Only the charitable remainder trust distributes cash flow back to the donor during their lifetime or for a set number of years. Is there an immediate tax benefit? Yes, in both cases, even though the money is not necessarily given to a charity in year one. And the big one here, the maximum allowable tax deductions are the same for both. If you donate cash, you can offset as much as 60% of your income in a given year. And if you donate appreciated assets, you can offset as much as 30% of your income. Well, let's say, for example, you donate more than 30% of your income in appreciated assets. You still have 5 more years to take the tax deduction against your income. So it's not like you lose the portion of the deduction that's disallowed in year one. Determining the tax deduction for donor-advised funds is easy. It's the dollar amount contributed to the account. For charitable remainder trusts, it's more complicated. The tax deduction is the estimated present value of the amount that will be left over for the charity at the expiration of the trust term. So that was a quick overview. Of course, reach out to me if you have any questions. Thanks for watching. We'll see you in 2 weeks.